Hey, day trader, how's it going? Good to see you. Thanks for joining us today. I got my full CFU gear on. I got the hat on. I got the hoodie on. I couldn't be more CFU. And if I go on backwards, check this out. You got the URL here in white stitching. Yeah, there it is. I think. Yeah, there we go. Awesome, right? Yeah, if you guys want some CFU merchandise, go to the website. It's off of the link's off our website. You can grab some stuff there. Bunch of hoodies and sweaters. I actually really like the sweaters. I've been wearing those all winter. All right, let's get going. Let's get started. So, welcome everyone. This is Covered Calls. We're going to turn stock ownership into a cash flow income stream. And this will also be available and recorded for all members. So, if you're watching the recording, welcome. We will be also publishing this as a PDF. So, this will be available to all members, our existing and well seasoned CFU members, and also our brand new ones as well too. So, welcome to the CFU community. If you've just joined, this is an amazing community where we trade for profit and try to get income off of the shares that we own and the cash that we have sitting on the side. Kyle's been doing a fantastic job lately. Same with Uzi with his Moderna trade, and Kyle with his doubling down on Novo Nordisk this week. If you haven't had a chance to check out, we did a YouTube video about that as well too. And of course, you can always check out all of our videos and live streams off of our website at joincfu.com. Session overview. So we're going to go through a few fundamental objectives here. We're going to define what a covered call exactly is, how it functions within your portfolio, our CFU philosophy of when we would like to sell covered calls. I'll give you an old example with Tesla, and I'll also give you an existing opportunity right now with ASML. The trade-off is that we have an immediate premium in exchange for capping our maximum upside potential. And we'll see that. I have a diagram of the profit and loss profile of a call option, and when you're selling the covered call, what that looks like. And so there's an advantage to being a seller in this scenario. We often consider it like the casino, right? Like two people go to the casino, one person's working at the casino, and one person's going there to gamble and to be entertained. And there's a long-term advantage for the house. And so with buying and selling options, we want to be the house. The covered call payoff structure, like we were talking about just recently, this is what the profit looks like of a covered call. And I think, yeah, I got my mouse here so it'll show up. This section right here, see this like little triangle here? This opportunity, this is what we're selling away. So in exchange for being paid out front, somewhat like a rental for your stock, the buyer of that call option, of that derivative instrument, is buying this opportunity here. This is what the call option holder wants to have. He wants to have that opportunity, and we're willing to sell that away. In exchange, we get that premium up front. He gives us, say, 60 or $100 for that opportunity. And then we still have, depending on the strike that you sell, we still have all this opportunity right in here to profit from this. And then we do take on the downside risk. So this is one of the biggest services we provide as the holder of the stock, is that we are willing to take upon us that downside risk. And in exchange for giving away this opportunity for that, we're paid up front. And this is often what the long call option person is trying to get. So this yellow gold area is our profit zone. The red area is our loss zone. We have the limited upside, and we're getting it capped right through here. And that's what we're being paid for. And a break even occurs. So this is the old break even point here. So this dotted line through here, what this is the profit and loss return for the stock. So it says up here, long stock only. This line is what that is. So if you just hold the stock, this is going to be your break-even point, and then this is your loss zone, and this is your profit zone. When you sell the call option, things kind of shift over a little bit here, okay? So there's a bit of an offset. The number of that offset is the premium that you just sold. Now you're over here. So now if say the stock is trading at 65, you sell $1 in premium. Now your break even is $64. I hope that makes sense. You've just been paid a little bit up front, and therefore your profit and loss as the covered call holder shifts over. You can see now you go all the way up here, you're getting all this profit, and then there's a certain point in time where it caps off, and now it starts to go sideways for you. You don't get any more participation there. This is likely something like you sold the 70 call and the market's trading at 65. Bang, now you're break even at 64. You get all that participation up to 70. And then after 70, the person who paid you money gets all the profit after there. And that's the basics of a covered call. What makes it covered? So this is a really good question. So what makes it a covered call? The coveredness or the security that is being played here is that you hold the 100 shares of stock that are making this call option fully insured or covered. It means that the obligation or the risk of it being called away or taken away, or that obligation of that contract being fulfilled, you hold the shares already to fulfill the obligation if that holder of the long call decides to exercise his right to buy the shares at that price. So that's why it's covered, it's secured. Okay. The defined risk, yeah, if it gets called away, he's going to take that away from you. There's no margin calls involved with a covered call. This is another element of a covered call that makes it much more secure. Other option trades that you could do. And the max loss is capped. So if we go back to our slide here, right out of the gate, we know what our profit and loss is, and everything is defined for us. So the most you could lose would be the price of the stock that you paid for or your cost basis there. So that's already known, and we already know what your upside is too. Okay, timing the entry, the CFUA. Okay, so this is a bit of our secret sauce that we bring into the mix for doing a covered call. So first off, we want to sell into strength. When most people are jumping into a covered call, what they're doing is they're doing a buy right. So they buy 100 shares of that stock and they immediately sell the covered call. That's one way of doing covered calls, but it's not really the optimal way. The optimal way takes a little bit more time. So over time, you dollar cost average into a position. And then after you've established that 100 shares, now you can start to sell some covered calls on it. What this usually does is it makes sure that you get a really good cost basis to start with. You're feeling very confident about the position, and then you can start selling some covered calls off of it. Volatility is the key. As you've slowly built this position up over time, now you're willing to sit and just wait for the optimal time for volatility to strike, and then you can sell into that. And I'm going to show you here right away. Mean reversion, yeah, that's part of the key elements that we're trying to sell into. Let's show it here. This is what I mean and what I was talking about just recently. So this is Tesla. This is the 1-day chart. And let's say you're bullish on Tesla. I go over this time and time again with Optimus, robotaxi, electric vehicles, power storage, the opportunity to get into SpaceX and with XAI, and you're fully participating in the Muskonomy, if you will. Okay, so let's say, for example, you're bullish on Tesla. So this is a daily chart. So this is recent here. So this is going to be back in probably like August or July of last year. And let's say every week or every so often you buy some shares. Sometimes you're buying it at the high if you're coming in from this time frame here. And sometimes you're buying at the low and you're getting some really good deals. So throughout here, you're starting to buy in and establish a position in Tesla. And it gets this nice big jump here, and you continue to dollar cost average in. As it jumped right here, this would have been a really good time to sell a covered call when it starts to get up into this range. This candle here, maybe even this candle here, it would be a good time to sell that covered call. Because through here, the volatility came down. And through here, same sort of thing, right? It's starting to establish a new consolidated phase of when people are valuing the stock evenly. It pulled back, and then this would be a great time to buy back that covered call or just let it expire. Where this was an absolute awesome time to sell the covered call right here. This is smack dab perfect timing. And actually, this is the time when our friend Kyle actually exercised a covered call. He sold that covered call. I think he sold like the 520 or so, and he was able to make a really good slice of income off of his position in Tesla. Now, this chart here, this might look like, oh, this kind of in hindsight, you wouldn't have known this. How do you know that's the time to sell a covered call? Well, as you set up your charting, this band becomes drawn onto TradingView. This band of premium comes into play because as the stock rose into here, what happens is the stock starts to find a liquidity pool. Okay, and a liquidity pool says at this point here, institutions are willing and very willing to sell the stock. And so as retail investors start to FOMO in, institutions or money managers on the other side will start to sell into that because it's a great time for them to sell. Just like this was a great time for you to be buying, this is a great time to be selling. That's an indicator that institutions and money managers are starting to flood the market with shares and meet that ever insatiable demand of buyers. This gets marked off as soon as you get this weak high, or even better, a strong high. That's a liquidity pool above the stock. Time to sell. Now, you may not want to sell your position. You might be like, you know what, long term, I still think it's a really good company, which I personally still do. But still, that's an opportunity when, like, you could have been selling the 550 or the 560 into some really solid strength. Now, of course, this is hindsight and we're looking back on Tesla, but I'm going to show you one that's right now today that would be fulfilling this exact same pattern. And that is, I'm going to bring it across here. And maybe I'll even go full screen on it here so you can get a better view. Where are you? Come on, full screen. There you go. Okay. So this is ASML, another stock that I'm extremely bullish on. If you know about ASML, they are the only company in the world that currently manufactures EUV lithography equipment. Okay, EUV lithography. That means they make them. So you might be saying, like, well, what's that? Lithography is how they make semiconductors. So, with transistors getting smaller and smaller, they're in a point now where it's impossible to make them. Like, it's always been that way, but then now it's like they're down to like 2 nanometers and they're about to go down to 1.4 nanometers within the next year and fulfill Moore's law. This is the company that makes the equipment that TSMC and Intel use to actually fabricate the chip. So NVIDIA, AMD, Broadcom, they don't actually manufacture the chips, they just design them. ASML sells the equipment to TSMC and Intel for them to actually manufacture and build the chip. So this is the run up that this has had. See, bang, it got into this weak high in here. This is a great time to sell a covered call on ASML. And the thing is you can actually get some really nice sweet premium on this. So I'll bring over, this is Option Strat. If you've never seen Option Strat, optionstrat.com. It's free to use. What you're able to do is come in here, input your ticker. So I can put, like, IBIT, for example. Say you want to look at Bitcoin option chain, gives you all your expiry dates. You can pick your strikes through here. But let's go back to ASML, okay? So we know the stock is trading at 1358. We're looking at this one here, right? So 1358, we're looking really nice. We know through here that we want to start selling a covered call. So let's go February 13th. And if we went to 1460, now I am cherry picking this because I've kind of looked ahead, but the 1460 covered call, or the call option, is selling at Delta 32. We'll get into what Delta 32 means, but this is a nice sweet spot. I always try to sell Delta 25 to Delta 35 if possible to get a nice premium. It's a good risk reward. Thanks, Option Strat. Yeah, Option Strat's fantastic. Let's see if I can get that on. Day Trader, thank you so much for that. And again, too, guys, if you have questions, now is a great time to ask them. If you're watching the recording, I'm sorry you just weren't able to ask them, but please, if you're live with me here now, ask those questions and I'll happy to answer them for you as we go through. Okay, so Delta 32 is perfect. Now look at this. You're going to get $30.50 per share. Now this is a high stock price. You got to have 100 shares of this. So that's going to be quite a bit of pool of money there. So you're looking at $135,000, right? See that? Where's my calculator? Bring that across. Come on. Oh, come on. Man, I can't get it to come across onto the presentation. So 35 times 100. So you need $135,800 in order to sell a covered call on this. So it's not likely that anyone's going to be selling a covered call anytime soon on this. And then you can see here the bid and the ask is really wide. That is a horrible bid and ask. So you know right out of the gate that it's going to be very low volume and a very low open interest. So this is not a well traded stock, but it gives you an opportunity to see here You can come in and say, okay, I want to sell it for 35. If you always go with the midpoint between bid and ask, that's a really good spot to be selling. You'll likely get a fill if you had something at like 35. Okay, so we've done that for February 13th. So we're about a month out, maybe 3 weeks out. We're doing Delta 32. That's a good risk reward. And that has roughly about a 30% chance of getting called away from us. Okay. So Delta is a measurement of how quickly the option price will move up and down, given for every dollar that the underlying stock moves up or down. And then it also is a pseudo risk probability of being 32% that it would expire in the money. So remember, this is a great opportunity to sell a covered call. So let's take Tesla here. This is the updated chart on Tesla. See how that was the perfect time to be selling that covered call? And then it pulled right back down. And now it's back at the 50-day moving average with the yellow line here. So this would not be a good time to be selling a covered call. This was the opportunity right there. Let's pick another one. Amazon, sure. I'm just randomly picking this. If I look at Amazon here, I likely would not want to be selling a covered call right now. This was a good time through here. And maybe when it broke and it ripped through and made a fair value gap, this back here would have been an awesome time when it was selling at a premium. So this right here would have been a great time to sell a covered call. CrowdStrike. I love this. This chart is so downward, it's not even funny. Yeah. Anyway, we talked about this in our last live stream, where this is a downward trend, breaks the 200-day moving average. It's making an equal low with January 2. Like, this is a very good bearish setup. I would sell call credit spread on that one. And I would try. Oh, I actually did. Actually, I think we posted that in CFU Black. All right, one more chart and then we'll move on. I see a delta of 28. Covered call today. Okay, let's see this one here. So let's go to MVTS. And NVTS. Thanks, day trader. NVTS. All right. So this is a good one. Okay. So day trader, tell me what you got for, what'd you do for a strike on this one? I see a delta of 28. My TA for MVTS shows 14, well above an upside gap. Yep. So you're talking about through here? Yeah, I see it that it's starting to gain some bullish momentum. I sold the TA. Oh, the 14. I gotcha. Okay, here it is. The 14 for, okay, gotcha. MBTS. Let's see it. Yeah, for Feb 2014, Delta 28. I see what you're saying. Yep. So that's a sweet spot to be selling. You know, you're in there, you got a 25% chance, 30% chance, give or take, of ending in the money, and you're down at $11. So you got a lot of upside there running, and it did 10% today. So that's good. Yep. That would be kind of midway between equilibrium and a strong high there. So you got a really good opportunity there. So that's the 5% return if I keep the shares and it expires worthless. Yeah, this is the benefit of a covered call. I can see your other comment too. This is perfect. Okay. So what's your, if you can, day trader, man, you should have just joined me on the stage so we can just do this live and just talking. But yeah, exactly. So this is your next comment here, that if you get called away at $14, you get a 31% return. Exactly. Yeah. And so it almost feels like you're winning either way, right? Like if it doesn't hit 14, you still get a 5% income return or profit of that call being expired worthless. And if it goes to 14, that's even better, because then now you're getting a 31% chance or a 31% return. I like sell on a higher grade. Yeah. See, this is what you want to be doing. You want to be through here, right? Going back to times like this. This is where you want to be dollar cost averaging in and forming your base of shares. So this is the best time to be establishing that position on MVTS, but even still through here. And then if you just started loading up in here in this area, so you got a good cost basis of $8 or $9. Even if you did the buy rate on that, that's a good possible return. It's already showing you that it can get up to $17, ride it from 14 to 17. Yeah, you got a good trade there. I like that. And also too, just for like $1,000, right? So you're looking at getting a $300 profit off $1,000 if this is even just done as a buy rate. So well done, day trader. Love it. Okay, let's get back to the presentation here. So post rally, if you got like a good earnings return through your earnings report, that's a good time to be selling as well too. So this is what we want to be doing. We want to be selling into strength. That's the best time. Yeah, exactly. You want to be selling into strength. So hopefully that makes a lot of sense to all of our members and traders, is that we want to be selling into strength. You don't want to sell a covered call into weakness, because that feels like you're just being paid to hold someone's bag while they run off, so to speak, right? And so you want to take advantage that. Okay, so you're talking about a put credit spread, just to give you full credit on that. So you're talking about doing a put credit spread or a cash secured put on this. Yeah, the profit return profile is nearly identical. That's my favorite trade, is a put credit spread. You'll see in our Discord when I'm trading and doing system trade alerts, like I've like worn out the button on a put credit spread. It is a fantastic trade. So let's look at that. We can bring that over and show everyone what that looks like. So if we did MBTS, we're bullish. We're going to go for Feb 20 day trader, do a bull put spread. Here we are here. So what we could do is we could sell. So you're at $10. You could sell, yeah, the $10 and put the $8 put on, or yeah, that would be a good one. So with this here, you're selling the Delta 32 again, which is great. And what this does is this doesn't give you as much profit overall in terms of dollar amounts, but you're only using $200 worth of margin. So you're getting like a 25% return on risk. Whereas with the covered call, you're getting roughly about 30% overall maximum if it went up to that $14 strike, which you would still profit. This would give you the $56 if it went up to $14, as we all know. But you've only put $200 up. That's your max. You're capped at that. You can't lose more than $200. And if we go over here, we can even see that being displayed in the profit loss. And then your total return is excellent, getting 25%. But with the covered call, the attraction of the covered call is I get a 30% return on more capital. And so I'm going to get $300 worth of profit on that. So if you're going to wind this up to get $300, you'd have to do about 6 contracts on this. And as the stock, if it did go down, which is your downside that you're taking on with this, as you go through like the $10 to $9, because you had to sell 6 contracts to get that same amount of credit or profit, it's going to whip through that really quickly, and you could end up losing 6 times 12, so $1,200 is what you could end up losing. And the stock only went down to like maybe 9, 8, or 750. Whereas the long stockholder is like, well, okay, it went from $10 down to 750. I lost $200 unrealized gains. And then as the put credit spread holder, you have to deal with something like a roll or something like that. So it may look less risky. However, it could actually be more risky on a immediate term trade to February 20th, right? So what I mean by that is from today until February 20th, if it dipped down to $8, you've now got a $1,200 unrealized gain, and you do have to do something to manage this risk. My playbook, I would always roll that out and continue to build that because I'm bullish on MBTS, let's say. So it's a little easier to manage the covered call. It makes a little bit more sense to most people who are starting off trading covered calls and trading options for income. So that's kind of the pros and cons of both of them there. So hopefully I kind of illustrated that, where it's like, yeah, great returns, very capped risk. But with that covered call income, it might be more absolute income that you're able to generate from it but it does require more capital, of course. So that's why like a lot of seasoned investors, this will be their first trade that they do will be with a covered call, because they've already got this long-term established position on like Tesla or anything else like that, right? They've been holding it for a long time. They're interested in continuing to hold it. So they just start selling covered calls on it and generating income. Okay, let's go on. And remember, this was an opportunity that we had and we shared this. So let's move on to the next slide. This was executed on December 12th. Yeah, so that's another thing too with those put credit spreads is you do need to have option level 3 in order to be able to sell those, which isn't difficult to qualify for. Just talk with your brokerage. They'll ask you a couple of questions, your experience, how well versed are you with options? What's your margin that you have? How much cash do you have? They just take a look at your portfolio and make sure you're good to go. Very easy to apply for and very easy to get approved for. I think Robinhood is like the easiest one to qualify for, probably likely too easy. I think you just need about 5 grand in order to get in there. But what I want to do is get into it. This is a real life example building off that previous chart that we had with Tesla. Kyle on December 12th. And if you're new to CFU, trade with Kyle. He's got 2 channels. Hopefully you guys can see this. I'm looking at the camera. So if you're new to CFU, you want to come in here, and I know at the first it can seem overwhelming with all the channels that we have. We really have tried to simplify this down. I think any long-term OG can attest to that. We have tried our best to simplify this, and I think it's about as low as we can go, and keeping it like we got to deliver the actual content, but we got to try and make it as easy as possible. The channel you want to key in on is Kyle's trades and 10K trades. This is with his small account that he's running. So this is like if you have like 10,000 or less, this is your trading channel to be taking trade alerts out of. You want to put notifications on this. Real easy. You just come in here, notification setting, and then like I have it on here, all messages. So what happens here is like if you're in the office, if you're on the road, as long as you got cell phone connection, which you always do, right? This will get you alerted. So you know right away Kyle's making a move, time to get in on that. We try to make our trade alerts as concise and simple as possible so you can follow that. And so you want to set alerts on Kyle if you have over 10K that you want to be playing with. 10K if you want to just keep it nice and capped, so $10,000 and less. I think over the last year, he took this account from $10,000 start, and now it's up to $3,000 of profit there. So he's been able to get it up 30%. Uzi's trade, he's a little more sophisticated. He'll be doing some, like, for example, the Jade Lizard strategy. Have you ever heard of that one before? It's good. Uzi always watches these videos. I say, Uzi, you're an amazing trader, and we always like the work you're doing. Just never heard of a Jade Lizard strategy before. So sorry, man. And then, just a little more combinations and stuff. So this is more advanced, but it's great to see how other traders trade. And then down below here, we have our system alerts. This is CFU Black. I manage this. This is our top tier trade alert system. We did a SoFi covered call today. This was coming out of a roll. We had to do a bit of risk management on this one. And here's our covered call on Bitcoin that we closed off for $25 profit per contract in just 4 days. So, I mean, it's not going to change your life money, but if you had enough contracts or a nice position in Bitcoin, that could be a nice income. And then down here, we have our other system trades, options, action, and weekly income. As you're getting started, you definitely want to turn on some of these channels and put notifications on. Uzi is a great one to be putting notifications on as well. And Lee, he is our whale in the community. I don't think it's my position to say how much money he's playing with, but he's got a lot. And so he does a lot of lower risk stuff. And you can see how someone who's got a lot of money trading options there. So he's got some really great trades that he does. 100% win rate. He's never lost a trade, which is, he's the only guy who can say that we have on our team. But he'll be selling like really high margin trades there. Okay, so let's get out of here and back to the presentation here that we got going. So this is an actual example of a trade that Kyle did. Let's make it full screen. Sold a covered call on December 12th. He sold the 15 call. Remember that chart that we were looking at before? How it was going up real nice. Sold the 15. He was slightly bullish, but he still wanted some income off that. And then on January 2nd, that same 15, he was able to pull that back and paid $146 in debit just to close off the obligation there. So he made $684, 82% premium capture. He was able to keep 82%. And it only took him 3 weeks to do that. So you can see here, he highlighted that he sold one for 30 and then he bought it back at 146. So perfect. He played that one to the textbook, right? So this is where he was selling, right? So he sold that high, that week high, sold that 515. So he would have been selling up in here, the 515 strike, which is even above the liquidity zone, which is perfect. Well played. And he was able to sell that nice call there. Okay. So CFU entry rules that we do. So we want to be selling into some strength. We want that 10 to 20 day to expiry on the covered call. You can go longer. There's been studies that have said that the 45-day DTE is the sweet spot or the most optimal. I think in today's trading activity, though, with there being so much volatility, high beta stocks such as Tesla or Coinbase, you don't have to sell 45. You can sell 10 to 20 DTE. So very easy to do. I like to sell Delta 25 to 35. Good trade between risk and reward and getting good premium for what you're selling into. And then strike logic, always try and sell above your cost basis and always try and sell out of the money for a covered call if you do on that one. Selling below your cost basis, you're taking on a different profile of risk because now you do have to manage what if I'm forced to sell below my cost. So presumably you picked a good stock to be trading. If you pick trash, well, you've got trash in your hands and that's your own fault. Pick good quality stocks so you think that long term this is truly going to go up. And so sometimes, yeah, you'll just have to wait it out and make sure that, okay, now the stock's above my cost basis, or I can sell the strike above my cost basis. Now I can make some money on this trade. Thanks to A Trader. Patience is the key. That's true. And so you can see that, and I practice that in some of our trades, like on Caesars, Campbell's Soup. Some of you guys don't even know that we're in those trades, and it's been a long haul, and I'm waiting for the time to sell that. I did recently do that on Target. If you remember on Target, we have the 90 leap on Target, and I waited and waited, and then once it got into like the 106 to 108, then we issued the trade alert to sell the covered call on that. And this is what it looks like. This is why it's important. Sorry, again, editor's going to hate me, but it's important that I show this. Come back, come back. Okay, so this is what we sold. So here's the chart that we had on Target. See, I sold right when we were getting into the premium zone. We had a weak high that got signaled. So down through here, we had this long leap, the 90 strike leap for like next January. So I got like a whole year to wait on this. And people and members were bugging me, when are you going to sell the Target covered call? In fact, in and around here, people are starting to ask really strongly when it was approaching 100, like, just wait. I really want to get this above. And once it hit into this zone, that's when I issued the trade alert. On this one here, for March 20th, sell the 115 call. Our current cost basis is negative $28 per share. So yeah, it's like $2,800. And our new cost basis is going to be $2,400 on this debit spread. But if we sell the 115 call and we get $4.15, that's going to lower it down from 28 down to 24. And then if Target can rally and get above $115 by March, then we can sell the entire position of the leap and the covered call. We can combine that together and sell it and remove the obligation. We can sell that for about $30.13. And we can net a profit of $500. So that's a perfect way to trade. Like, we had the leap, we're waiting for it, and then we're going to sell the covered call on it. This is an important note too, because this is a long duration trade. We don't want to be entering this as a brand new, because you're not going to get the cost basis that the previous traders and members had been given. So I put a little warning on there. Don't jump into this trade. This is not one you want to jump in on if you're not an existing holder of the position. It pays to not wait only for being in profit, but also for the stock to reach an oversold condition or at least a strike above resistance. Exactly, right? So now it's already proven beforehand that it has resistance here. Came back down. It started to descend, it went past equilibrium, started to put in a position here for a strong low. So this is the perfect time to start buying Target because it had established that that's when it's going to be finding a lot of support. And like, not a lot of retail traders want Target in their portfolio, but institutions love it, right? It's the play of like, well, maybe Amazon won't be as dominant as it once, whatever. Anyways, it starts rising up. This is when you want to be selling the covered call option on there. Yeah, sell a strike above resistance. So we went into resistance. Now let's sell the 115, 116, or 120 strike on that one. Okay, so that illustrates that point for us. Okay, so this is exactly how we play Target. Now I need to make this present full screen. There we go. Okay, so the possible outcomes. So the stock declines below break even. That sucks. Oh, well, we already talked about this. Retain your shares at a loss, partially offset by premium. Sure, you can sell another call. You may have to go further out or higher up in order to stay above your cost basis and sell into that strength maybe. I personally like to just hold it. Just wait, wait, wait. I know it sucks. And I know as a Discord, you guys don't want me just holding it and doing nothing with it. But it's the best option sometimes. It's just to sit and hold. And then we sell into strength, like we've already talked about. Stock between the break even and the strike. If it's above your cost basis but below your strike, that's fantastic. You get to keep full premium. You don't have to sell your shares. You could sell them if you want to because you're above your break even or you're above your cost basis. Sell them, get out of it, go into your next trade. Or if it's a long term hold, this is like optimal. Stock didn't move, didn't go into your strike. You get to keep the full premium. You got your income. Stock at or near the strike. This is like perfection. We did actually pull that off with Bitcoin this week. We sold into strength and it just kind of stayed there at around the 54. And so we did get that perfect trade on the covered call there for Bitcoin this week. The call expires worthless. You get to keep the premium and your shares actually even appreciated too. So it's like the holder of that call absolutely hates life. He's like, man, I paid that guy money and I didn't get any of the upside profit. He actually made money on the stock or the ETF in this case with the IBIT appreciating a little bit. This is the outcome that people will commonly say is the risk that you hold with covered calls, and that's a misconception. Yes, this is a risk that you hold. It's not your worst case scenario. Let me show you what your worst case scenario is for your risk that you hold. Let's just do SPY for now. Let's sell the February. We're at 691, February 20th. Let's sell the 710. Okay, so this is what people say is your biggest risk as a covered call. And I'm going to show you it's absolutely not. Would you sell this one? Yeah, so 24, that's not bad. Let's just do the 710. Yep. So this is a sweet strike to sell. Delta 25, you're going to get paid $340 for sitting on 70 grand. So I would sell anything in the 705 to 10, depending on how conservative you want to be. So let's just say you sell the 10. People will say to you, your biggest risk as a covered call holder is you don't get any of this upside here. I need to change the range so you can see some more. Okay, so they're going to tell you this is your risk up here, that all through here you don't get any of that profit. It's not really your biggest risk. That's just like opportunity cost. You didn't realize as much profit as you could. And so your annualized returns won't be optimal, but you're not losing money if you sold above your cost basis, of course. This is your biggest risk right here. It always is with covered calls. Your biggest risk is to the downside. So let's say you sell this 10 and then your optimal outcome is that it ends at like 708, 709, right? Expires worthless and you got some stock appreciation. So it ends at 690. Well, you got all that premium that you captured and it ended at 690. And so you're not losing any money. Perfect. Now you get down into here. Let's say it goes down, it starts declining and declining. If it gets down to 650, you just lost $50, $41 per share. And yeah, you got paid what? $300? You got paid $350 and then you lost $50 per share down through here. That's where it sucks. This is your biggest risk through here. Okay, so I just want to always clarify that with covered calls. Your biggest risk is not your opportunity cost to the upside. Your biggest risk is the downside that you're holding. And this is truly what the call holder is paying you for. You hold the bag while I take all the upside profit. Okay, so that's your biggest risk. And then your second biggest risk is, the opportunity cost to the upside when it surges. And you basically, with the covered call, those are the two risks that you need to manage. Okay, so that's number 4 and number 1. These are your two risky outcomes. And then number 2 and 3 possible outcomes. These are yours, like awesome. You're loving both of these. Okay, so active management and profit taking. So treat your covered calls as though you're trying to harvest some income. I love this little graphic. He's out in the wheat field gathering his income. His income's supposed to be this wheat, and he's going to make some bread. That's awesome. Take profits early. Don't be afraid to close out your position. If you entered into a buy right, once you get into that 80% sweet spot of profit, you should probably close off the trade. That last little bit from 80 to that's where you're taking on a lot of gamma risk. Gamma risk is another word for tail risk. And so as you think about like a bell curve, you don't want to be taking on that risk on the ends of the tail. Once you get into that, like, hey, we got 90% of the profit, it's time to book it and go, because now there's very little remaining profit left for you, but you've got this time risk against you that every day is an opportunity for those tail events to actually occur. And then it whipsaws, and then you got a real problem on your hands. So once you get into that, hey, this is the most I'm going to get, I'm 80% of the way there, start thinking, hey, man, time to wrap this up and move on to the next trade. That's a better use of capital over time. When's the best time to sell or to close off an option position? Is it worth it to go to 100% of possible profit? All the models will tell you once you get into that 90%, time to book it and run. Yeah, trying to squeeze out that last 10 to 20% can be really painful. Thanks for that, day trader. It's just not worth your risk. I've been trading options for 17 years. I've been doing it with CFU for 3 years, day to day, every single day. I've seen every single possible outcome. Once you get past 80% of your profit, man, you'll see how some of the outcomes will happen. Like, man, I should have just taken that profit. And because now you got to roll it. Now you got to kick it off like another 2-3 months. So lock that in, 80% of max profit, start closing out the position. Yeah, because like news hit, like seriously, like once you're into 90%, and then Trump puts out a tweet, and now you're like, oh, well, the hell. That's exactly what you don't want to have happen. We saw that with electronic arts this year. We had a call credit spread, so we were bearish on electronic arts, and we were at something like 60 or 70% profit. Like, let it go, let it get up to the 80%. And then some guy, I think he was related to Trump, maybe he was like a son-in-law or something, agreed to buy out electronic arts. So all of a sudden, the stock goes from like 150, 160 to $200, and there was nothing we could do about it. We got caught on that one. And yeah, it was one of the few trades we've had to actually close off for a loss. So don't wait around for that last 10 cents or 20 cents. Rolling, don't be afraid to roll. The Saudis bought it with Kushner. That's right, it was. Yep. I was like, yeah, man, there's no way that Kushner or like his son-in-law could have afforded that on his own. But yeah, I team up with the Saudis, and then they can buy it. There you go. If you don't know what this means right now, don't worry about it for now. If you're new to option trading, we'll do a whole new webinar and live stream on rolling. It's one of the most controversial elements of trading options. I love to roll. I have no problem rolling. I'm a rollaholic, if you will. But other traders think they don't want to do it. And case in point, Kyle, our best trader, doesn't want to do them, or does very few of them. He will roll sometimes, but most of the time he'll close off for a profit. Key takeaways: it's a great tool for cash flow. Discipline wins. Don't try and outsmart yourself. Keep it simple, and sell into strength, sell into high IV or high implied volatility when things are a little uncertain. Sell that covered call when people are getting really excited about the stock that you already own. I know it sounds a little counterintuitive, because you're like, oh, I got the stock, it's doing really well, and I want to hold on to it forever. Nah, man, sell that covered call, make some extra profit on it. That's the time you want to be selling a covered call. The goal is to get consistent, repeatable income that compounds over time. And that's all. We made it through the slide deck. Well, good for us. That's amazing. Okay, so this is going to be available as a PDF. We'll have that out hopefully this weekend, and we'll definitely get the video out this weekend. It will be cut and edited down because I made so many mistakes as we go through, but that's life. That's how it goes sometimes. If you're new to CFU, thank you for just recently joining us. If you're an OG who have been with us for 2-3 years, thanks for being around. CFU is an amazing community, and we're growing every month. And if you're thinking about joining CFU, if you're watching this on YouTube, join. Go to joincfu.com, check it out. We have the Discord where we have our trade alerts, which you saw here today. We have our website, we have a blog, we have a newsletter. and it's a great community to be a part of. And you're going to be able to make great profit, learn how to trade options, see what stocks guys are buying, and see what stocks they're selling, and keeping up on top of all the news. So thanks for being with me today, guys, and we'll talk to you soon. Take care. Bye bye.